You feel excited. You invest immediately. But here is the truth. Past performance does not guarantee future returns. Markets move in cycles. A fund that performed well last year may underperform next year. Example: you invest 1 lakh rupees in a small cap fund after seeing 30% return. Next year, market corrects. Portfolio drops to 80,000 rupees. Emotion hits. Doubt begins. You exit. Loss becomes real. Smart investors do something different. They look at long-term consistency, 5-year, 10-year track record. They check downside protection, not just upside returns. They compare with category average, not just top performer. Consistency beats excitement every single time. No asset allocation. This mistake is dangerous because it feels right. You invest everything in equity because returns look high, but risk is ignored. Example: you invest 10 lakhs rupees, 100% in equity funds. Market crashes 40%. Your portfolio becomes 6 lakhs rupees. Panic starts. You sell. Loss locked. Now compare this. Same 10 lakhs rupees, but with allocation. 60% equity, 30% debt, 10% gold. Market falls 40%. Portfolio may fall only 20 to 25%. You stay calm. You continue investing. Recovery becomes possible. Asset allocation reduces damage and protects discipline. Simple rule: never go all in. Balance creates stability. Stopping SIP during bad times. This is emotional investing. Market falls. News is negative. Friends are scared. You stop SIP. Feels safe, but it is the biggest mistake. SIP works because of volatility. When prices fall, you buy more units. Example: 5,000 rupees SIP at NAV $50. You get 100 units. At NAV $25, you get 200 units. Double units. Future gains increase. If you stop SIP, you miss this advantage. Real wealth is created during downturns, not during bull runs. Continue SIP no matter what. That is discipline. Ignoring rebalancing. Investing is not one-time work. It needs maintenance. Over time, your portfolio shifts. Example: you start with 60% equity. After 3 years bull run, equity becomes 75%. Risk increases silently. Then market falls. Heavy loss. Rebalancing fixes this. You bring allocation back. Sell some equity. Move to debt. Or buy equity in crashes. Do this once a year, or when allocation changes by 5 to 10%. This controls risk and improves returns. Without rebalancing, you are drifting. Ignoring taxes and exit planning. Returns are not what you earn, they're what you keep. Many investors ignore taxes. Example: you make 1.5 lakh rupees profit. Long-term capital gains. 50,000 rupees taxable. 10% tax. You lose 5,000 rupees. Short-term, 15% tax. Even more impact. Planning matters. Also, no exit plan means confusion. You don't know when to withdraw. Money stays stuck, or you exit randomly. Smart investors define goals: retirement, child education, house purchase. Each goal has a timeline. Short-term, debt funds. Long-term, equity funds. Exit gradually, not in one shot. Tax awareness increases real returns. No scaling strategy. You start small, 3,000 rupees SIP.
Good beginning, but income grows, inflation grows. SIP stays same. Wealth growth slows. Solution? Step up SIP. Every year, increase by 10 to 15%. 5,000 rupees becomes 6,000 rupees, then 7,000 rupees. Over 15 years, this creates massive difference. Small increase, big impact. Scaling is powerful. Over-diversification. More funds feels safer, but it reduces returns. You hold 15 funds. Many overlap. Same stocks. Repeated exposure. No real diversification. Just confusion. Tracking becomes hard. Rebalancing becomes messy. Ideal approach: 4 to 6 funds. Large cap, mid cap, flexi cap, debt fund. Simple, clear, effective. More is not better. Better is better. Emotional decisions. This is the root cause. Fear, greed, bull market. You become overconfident. You invest lump sum at peak. Market falls. You panic sell. Loss confirmed. Cycle repeats. Successful investors follow rules, not emotions. SIP continues. Asset allocation fixed. Rebalancing yearly. No panic, no excitement, just process. Discipline beats intelligence, always.
Investing without understanding the fund. Many investors choose funds blindly, based on friend advice or social media, but they don't know what the fund actually invests in. Large cap, mid cap, sector specific, all behave differently. Example, you invest in a technology fund because it gave high returns, but tech sector falls. Your portfolio drops heavily because risk was concentrated. Before investing, understand fund objective. Check portfolio holdings. Know the risk level. Clarity reduces panic. Timing the market. This sounds smart, but rarely works. You wait for market to fall to invest. Market keeps rising. You miss opportunities. Then you invest at peak. Market corrects. Loss begins. Reality: no one can consistently time the market, not even experts. Instead, follow systematic investing, SIP, or staggered lump sum. Time in the market is more important than timing the market. Ignoring expense ratio. Small number, big impact. Expense ratio is the cost you pay fund house. Example, Fund A, 1.8% expense. Fund B, 0.8% expense. Difference, 1%. Over 20 years, this can reduce lakhs from your final corpus. Higher cost means lower net returns. Always compare expense ratios, especially in similar funds. Lower cost, better compounding. No long-term mindset. This is the final mistake. People expect quick returns, 6 months, 1 year. If returns are low, they exit. But mutual funds are long-term instruments. Equity needs time, minimum 5 to 10 years. Example, 5,000 rupee SIP for 1 year gives small result. Same SIP for 15 years creates wealth. Compounding needs patience. Short-term thinking destroys long-term gains. Stay invested, stay patient. That is where real wealth is built. You don't need perfect market knowledge. You need controlled behavior. You don't need to predict. You need to stay consistent. You don't need more funds. You need better decisions. Years later, when your portfolio grows, you will not thank the market. You will thank your discipline, quietly, confidently, because you didn't chase returns. You protected them.